Hello, everyone. This is a review on governance, ethics, and quality management. So, this review will be divided into four parts. The first part is our discussion on corporate governance. The second part will be all about ethical standards and responsibilities of professional accountants. Then, the third part is the longer part, and that is all about the system of quality management. And the last part is the regulatory requirements that are related to practice, accreditation, and regulation of public accounting and auditing service. So let's start with the first topic, and that is your corporate governance. So before we formally discuss the topic on corporate governance, we have to understand first what is governance in its basic term. So, what is governance? Governance is the process of decision making and the process by which decisions are either implemented or not implemented through the exercise of power or authority by leaders of the country and or organizations. So this shows that the concept of governance is not only applicable to business organizations, but rather it's a general concept. It could be applied in any type of organizations, could be business organization or governmental organization. So again, governance is the process of decision making. So we make decisions, right? And then these decisions could either be implemented or not implemented. And who exercises this power? So this power to either to decide whether this particular decision should be implemented or not implemented, this power is exercised by our leaders. So the leaders of the country or the leaders of the specific organization that you are looking at. So, what are the characteristics of good governance? So, our goal is to implement good governance, right? So, for governance to be considered good, a good governance, the following should be present. So, there should be participation, there should be accountability, effectiveness and efficiency, equity and inclusiveness, consensus, it must be consensus oriented. There must be responsiveness, transparency, and the following of the rule of law. So let's discuss these characteristics one by one. So the first characteristic of good governance is participation. Again, remember that we are talking about governance here in its general perspective. Okay, not just limited to a business organization, the governance in a business organization. So first characteristic is participation. So participation of both men and women is a key cornerstone of good governance. The participation could either be direct or through legitimate institutions or representatives. So in general, there should be equality, right? Equality in the right to participate in a particular decision. Okay, so the voice of everyone, regardless of gender, regardless of race, regardless of experience, their voice should be heard. They must be given the chance and the right to participate. Then their participation could be exercised directly, so meaning they themselves, no, they themselves will participate, will voice out their concerns, or could be indirect. So the participation could also be indirect. So when can we say that the participation is being exercised indirectly? For example, if they have certain representatives, could be in a form of another person. Let's say there is another, you have a representative, one person, or you could also be represented by an organization or a group. Okay, so your voice could be heard through them. So it could be directly or indirectly. It is important to point out that representative democracy does not necessarily mean that the concern of the most vulnerable in society would not be taken into consideration in decision making. So the concept of democracy, as related to participation as being a characteristic of good governance, means that everyone should have a voice. not just in our country, but also we could apply that in our business organization. Everyone should have a voice. And then the concept of democracy is that the majority wins. So the decision of the majority will win. For those in minority, doesn't mean that their voice will not be heard, but rather um, their voice will be taken into account, and then this decision will be voted for. So whether most of the participants voted for this type of decision or not. So we can also apply the concept of democracy. Participation needs to be informed and organized. So it doesn't mean that if you have the right to participate, you can exercise this right in whatever form you want. So that's not what this means. So you have the right to participate, but just make sure that the exercise of this right to participate is being made in an organized manner. Okay. So this means freedom of association and expression on one hand, and organized civil society on the other hand. So you have the freedom to express your thoughts. You have the freedom to associate yourself with legitimate institutions. And on the one hand, there is this obligation for us to follow the rules of a civilized society. So these two should go hand in hand. Okay, another characteristic of good governance is the rule of law. Good governance requires fair legal frameworks that are enforced impartially. So there must be a law or a rule that governs our participation in this process of governance. So in a national perspective, we have these statutes, we have these laws, right? Rules and regulations. If we are to apply this in a specific business organization, we have our company policies, we have our bylaws. Okay, so these legal frameworks or these rules should be enforced impartially. Impartially meaning there is no favoritism. Okay, so whether you are just a mere rank and file employee or whether you are a supervisor, a manager, or a member of the board, the rule or the policies of the company should be applied. It requires full protection of human rights, particularly those of minorities. Impartial enforcement of laws requires an independent judiciary and an impartial and impartial police force. So this is rule of law in general, right? We have the lawmaking body, we have the decision-making body, no? The body that decides whether a particular rule has been violated, and if it is violated, what is the appropriate sanction, what is the appropriate penalty, and then we have the enforcement. Okay, so in a company, if we are to apply this in a business scenario, we have a group of people that crafts policies, right? And then we have the human resources department that would act as a judge as to whether a particular rule has been violated or not. So that is why if a particular employee is being charged with an infraction of a company policy, then that employee will be uh, called to the HR. They will meet in the Human Resources Department. The Human Resources Department will act as the judge. And then your managers, no, the managers of the respective departments will be the one to enforce the policy, will make sure that the policies are being followed. Another characteristic of good governance is our transparency. So what do we mean by transparency? Transparency means that the decisions taken and their enforcement are done in a manner that follows rules and regulations. It means that information should be freely and readily available, directly accessible to those who will be affected by such decisions and their enforcement. So transparency, uh, the root word for this is transparent, so you can see through it. So if there are specific decisions that are being implemented by a certain organization, they must make sure that the information related to such decision, or for example, how they came up with such decision, what are the information, what are the data that they have considered, before coming up with such decision. What is the effect or what are the effects of the decision? So the this type of information should be readily available to those affected by it. So for example, in the organization, let's say, the board has decided that the working schedule of the employees, instead of just Monday to Friday, they will extend it to Saturday. So Monday to Saturday. So the employees will be directly affected by this decision. So if I am the employee, I am one of the employees of the organization, I would want to know the all details of this decision, how it affects me, why, what is the rationale for this decision. Okay, so that's transparency. You cannot say, for example, if you are a member of the board, you are not allowed to say that it's just our decision. You cannot question it. Okay, that is not the characteristic of good governance. Next characteristic is responsiveness. So good governance requires that institutions or organizations and processes try to serve the needs of all stakeholders within a reasonable time frame. So if there is a certain concern, if there is a certain feedback coming from the members of the organization, the board should be responsive to these um, concerns or feedbacks. They must look into it within a reasonable time frame. Then, good governance is also consensus oriented. So, good governance requires mediation of the different interests in society to reach a broad consensus on what is the best interest of the whole community and how this can be achieved. So, we can also relate this to the first characteristic, which is participation. So, in participation, it just means that all our opinions, no, as members of the organization, should be considered. And in relation to that, we have this consensus oriented. This means that majority wins. Now, what is the best interest of the whole organization? Not just one person. Okay, not just what is good for one person, or not just what is good for the board of directors, but rather what is the best decision that would cater to the interest of the whole organization. Okay. Then another characteristic of good governance is equity and inclusiveness. This ensures that all its members feel that they have a stake in it and do not feel excluded from the mainstream of society. This requires all groups, but particularly the most vulnerable, have opportunities to improve or maintain their well. So, um, the decisions of the organization should take into account the interests or what is good, what are the needs of the minority. Okay, for example, in a business organization, the board of directors should also take into account the needs of its rank and file employees. So, for example, the rank and file employees are just receiving minimum wage rates. So, depending on the place, we have minimum wage rates ranging from 350, around 350 to 400, almost 500 pesos per day. So, if you have equity, if you practice equity and inclusiveness in your practice of governance in your organization, you would also ask yourself whether it is high time for you to raise the salaries of these rank and file employees if the company resources permit you to do so. So if you have lots of retained earnings, that means that you have so much, no, you have so much income. So it's probably the time to revisit your wage policies, right? So this is the practice of equity and inclusiveness. And then we also have accountability. So this is a very important characteristic of good governance. Accountability is a key requirement of good governance. Not only governmental institutions, but also the private sector and civil society organizations must be accountable to the public and to their institutional stakeholders. So this is accountability in general. If we are to apply this in the concept of corporate governance, meaning governance that is specifically applied to corporations or juridical entities, business organizations. Accountability means that the roles and responsibilities of each member is being defined such that if there are any issues that arise related to such responsibilities or roles, that person should be held accountable for it. So, who is accountable to whom varies depending on whether decisions or actions taken are internal or external to an organization or institution. So, for example, the board of directors are answerable to the stockholders. So, for example, if there is a bad decision made by our board of directors, the consequences of their decision, the negative consequences of this decision should be explained to the stockholders. Okay, this is then exercising accountability. So owning the responsibility of um, answering to the consequences of their actions or decisions. Okay. So let's now focus on corporate governance. So a while ago, what we have discussed is governance in general. So at this point, um, let's focus on corporate governance. So corporate governance is the system of rules, practices, and processes by which business corporations are directed and controlled. So take note only business corporations. So that is the concept of corporate governance. It basically involves balancing the interests of the company's many stakeholders, such as your shareholders, management, customers, suppliers, financiers, government, and the community. So all of their interests of these persons, of these stakeholders, should be balanced out. Okay. So what is the purpose of corporate governance? The purpose of corporate governance is to facilitate effective, entrepreneurial, and prudent management that can deliver long-term success of the company. In simple terms, the fundamental aim of corporate governance is to enhance shareholders' value and protect the interests of other stakeholders by improving the corporate performance and accountability. So again, as mentioned a while ago, corporate governance aims to balance out the interests of the different stakeholders. Diba? Who are our stakeholders? Again, we have the shareholders here, we have the management, we have the customers, suppliers, and so on. So we have to balance out their interests. That means we don't just focus on the interest of one stakeholder. So for example, if you are to look at the interest of the stockholders or the shareholders, what is their main interest? Their main interest is to gain profit, receive dividends from their shareholdings, right? But what is the interest of the employees, for example? So the interest of the employees is to earn decent income. How can we balance them out? Another stakeholder, the government, what is um, the interest of the government? The interest of the government is for us to follow the rules and regulations of the government, for us to pay the correct taxes, for us to submit the required documents specified period of time. Okay, so corporate governance is there to balance out the different interests of our several stakeholders. It is also about what the board of directors of a company does, how it sets the value of or the values of the business firm or organization. So what are the objectives of corporate governance? The first objective is fair and equitable treatment of shareholders. A corporate governance structure ensures equitable and fair treatment of all shareholders of the company. So we all know that shareholders could be majority shareholders or minority. So for example, if you own 50% or a huge percentage of the overall issued shares of a particular company, then you have more votes, right? You have more votes. But what if you just you just own, let's say, one share out of the 1 million shares. So should you be treated differently? The answer should be no. So corporate governance must aim to achieve fair and equitable treatment of shareholders, regardless of the level of their shareholdings. Whether you are a minority shareholder or whether you are a majority shareholder, you have the same treatment. Then another objective of corporate governance is self-assessment. So this enables firms to assess their behavior and actions before they are scrutinized by regulatory agencies. So it's like self-regulation, right? Corporate governance is like self-regulation. You judge yourself first before you could be judged by external um, entities, or before you are judged by our government regulatory agencies. So you have to correct your mistakes first internally. You have to point out which ones are not good for the firm, which ones need improvement. So it's self-assessment, it's self-regulation, and that is also one of the objective of why corporate governance is there, why corporate governance is being exercised inside a business organization. So an active and independent board can successfully point out deficiencies or loopholes in the company operations and help solve issues internally on a timely basis. Another objective of corporate governance is to increase shareholders' wealth. So again, as mentioned a while ago, the main interest of the shareholders is to earn profits from their shareholdings, to receive dividends. So good corporate governance should aim also to the increase in the market value of the shares, thereby increasing the wealth of their shareholders. So this is to protect the long-term interests of the shareholders. And then another objective is the promotion of transparency and full disclosure. It must aim at ensuring a higher degree of transparency in an organization by encouraging full disclosure of transactions in the company account. So all stakeholders could get the chance to uh, review company accounts, company books, and records. If there are any questions or if there are any issues with regard to their business interest, they can readily access the information because of this transparency and full disclosure. In fact, I have met with several clients, that have this problem on corporate governance, mainly because let's say they have a company, and this company was established by their, let's say, great great grandfather. Then this is just passed on from one generation to another. So the current set of board of directors were just there simply because they are the descendants of the original owners, right? So they are just there, but they do not have any idea as to what to do, what are their roles, no, in the company. So they just want to receive salaries or honorarium, rather honorarium from from the mere fact that they are board of directors. They just want to receive honorarium, but they do not know the concepts of good governance. There is no transparency. They do not have good relationship with the other shareholders. So this concept of corporate governance, particularly good corporate governance, must be inculcated in the minds and hearts of the board of directors that are running the firm. Because eventually, if they do not practice this not good governance, their company is doomed to fail. Okay, so who are the parties involved in corporate governance and what are their respective responsibilities? So the shareholders, they provide effective oversight through the election of board of directors, the members of the board of directors. So who will vote, no, who will nominate and vote for these persons to become board of directors members? It is the shareholders. Okay, so the shareholders also have a part in the good governance, in the good corporate governance of the business organization. But the major players of good corporate governance are actually our board of directors. So the board of directors are the major representatives of stockholders to ensure that their organization is run according to the organization's charter and that there is proper accountability. So since the board of directors are being elected by the shareholders themselves, they are saying that the members of the board of directors are their representatives of the whole shareholders or whole stockholders. So the board of directors must keep in mind that they are playing this role. No? They are the representatives of stockholders. Then we also have non-executive or independent directors. So not all companies are actually required to have an independent director. So there are other companies, mostly companies that are vested with public interest. So for example, banks, financial institutions, they are required to have an independent director. So the independent director is performing the same role as that of the original or the ordinary board of directors. Then we have the management. Okay, so the board of directors, then come the management. So the management is responsible for operations and accountability. They manage the organization effectively, provide accurate and timely reports to shareholders and other stakeholders. So you have to, at this point, you have to remember that the board of directors is different no, from the management. The board of directors, the role of the board of directors is merely oversight function. They do not dip their toes in the overall daily operations of the business. So the board of directors is merely oversight. Okay, then we have the management. We have the managers of the different departments. They are the ones in charge or responsible for the day-to-day operations of the business. So the board of directors do not receive salaries, but they could receive honorarium. The management, composed by our different managers, various managers, they receive salaries. So board of directors, honorarium, management salaries. Board of directors are not employees. They are not employees of the organization. But the management, they are employees of the organization. Okay? Okay, another party that is involved in corporate governance are our audit committees. Okay, the audit committee is in parallel to the board of directors. The audit committees will report to the board of directors and not to the management. Okay, so the audit committee will report to the board of directors. In fact, the audit committee is the one who will choose who should be the external auditor of the company. So the audit committee provides oversight of both the internal and external audit functions and the process of preparing the annual financial statements as well as public reports on internal control. Then another player are our regulators, such as our Board of Accountancy and Securities and Exchange Commission. Then we have external auditors. You all know what is the major role of external auditors. They perform audits of financial statements. We have internal auditors. These are auditors that are employed by the company itself. They perform audits of companies for compliance with company policies and laws, audits to evaluate the efficiency of operations, and periodic evaluation and tests of controls. So for external auditors, they just focus on the presentation of the financial statements, whether they have material misstatements or not. And if there are material misstatements, then the external auditors would give you a recommendation. And then after which the external auditors will give you an opinion. So whether they would give a qualified opinion, adverse opinion, and so on. But the internal auditors will audit the different aspects of the organization. So for example, they would audit the operations. They would audit the particular department, let's say the manufacturing department. So that's the role of internal auditors. So all internal auditors and external auditors are being um, managed by our audit committees. Okay, so that ends our discussion on the first topic on corporate governance. The second part of this discussion will be all about the ethical standards and responsibilities of professional